By the end of this video, the parts of the annuities exam that confuse everyone are going to make complete sense. That's the deal. Most people study the definitions but fail the application. We're going to break down the logic behind accumulation errors, payout pitfalls, and the tax traps that sink scores. Let's get into why these concepts trip you up and how to fix it. If you're treating annuities like a standard savings account, you've already lost. The exam wants to see if you understand the unique math and the restrictive rules. Let's look at the first major error people make when the clock is ticking. Okay, quick reset. People often treat the growth phase like a flexible checking account, and that's a fast way to lose points. Right, quick note. Think of the accumulation phase like building a house. You're stacking bricks and pouring concrete, but you can't live in it yet. Students often mistake this growth period for a time of high liquidity. It's not. The wrong answer usually suggests the owner can just pull all the cash out for a vacation without a tear. Why is that tempting? Because it's their money. But here's what nobody tells you. Until you hit the payout phase, that money is effectively behind a glass wall. If you break the glass, it costs you. Imagine you sign a 3-year lease for an apartment, but you try to move out after 6 months. The landlord is going to charge you a massive fee for breaking the deal. That's a surrender charge. Most candidates forget that these charges are on a sliding scale. They don't stay the same forever. What I see students do is assume the charge applies to the death benefit too. It usually doesn't. If the owner dies, the company typically waives that early exit fee. Right, keep that distinction clear. Think of annuitization like launching a rocket. Once you hit the go button and the engines fire, you aren't bringing that rocket back to the pad. The mistake here is thinking you can unannuitize and go back to the growth phase. You can't. Once the contract converts into a stream of income, the principal is gone. It's now just a promise of payments. Actually, let me back up. You're trading your lump sum for an income guarantee. If you understand that trade-off, you're in better shape than you think. Now, here's the thing about payouts. People pick the wrong option because they focus on the feel-good choice instead of the math. Higaridwanel says, right, quick note. This is like betting on how long your car will run without a warranty. If the car dies tomorrow, you get nothing back. Because it's the riskiest for the client, it offers the highest monthly check. Candidates often avoid this answer because it seems mean that the insurance company keeps the money if the person dies. But on the exam, if the question asks for the maximum monthly income, this is almost always your answer. Don't let your emotions pick a lower paying option for the client. Here's the exam day version. Think of this like a prepaid parking meter. Pay for 10 minutes. If you leave after 5, the meter still has 5 minutes left for the next person. But if you stay for 15 minutes, you're still covered because you're still there. It's a hybrid. You get paid for life, but if you die early, the payments continue to a beneficiary for a set time. Students get confused and think the payments stop after the period ends. No, they only stop if the period ends and you're dead. Stay with me here. Imagine a relay race where the second runner keeps going until they hit the finish line, regardless of what happened to the first runner. The mistake here is forgetting that the check often shrinks when the first person dies. A joint and 50% survivor plan cuts the check in half for the spouse. Why do people miss this? They assume survivor means the full amount continues. Read the percentage carefully. If you caught that distinction, you're doing great. Okay? Right, let's talk about the IRS. Most people fail this section because they try to apply common sense to tax law. Wells. Think of a bucket of water where you poured in the clear water first, then topped it off with blue dye. If you dip a cup in, you're getting the blue dye first. In annuities, the blue dye is the interest. The IRS demands you take the interest out and pay taxes on it before you can touch your tax-free principal. Use the mnemonic LIFO, last interest, first out. What's the trap? Thinking it's like a bank account where you only pay tax at the very end. Nope, the IRS wants their cut of the growth immediately. Okay? This is like the early bird special at a restaurant, but in reverse. If you show up too early, meaning before age 59 and a half, the government hits you with a 10% surcharge. Candidates often forget this is in addition to regular income tax. It's not one or the other. What people do wrong is they assume the penalty applies to the whole withdrawal. Actually, it only applies to the taxable portion, the earnings. If you're withdrawing $100 and only $10 is growth, that penalty is only $1. See the difference? So, watch this. Imagine you're sorting a basket of laundry. Half is yours, half is your roommate's. Every time you pull out a shirt, you have to decide whose it's. The exclusion ratio tells us what percentage of a non-qualified payout is a tax-free return of your own money. The mistake? Applying this to a 401k or IRA annuity. In those qualified plans, the exclusion ratio is 0 because you never pay taxes on any of it. It's all taxable. Let's think about this differently. The exclusion ratio is only for money that was already taxed once. Stay with me here, we're almost at the finish line. The final mistake is mixing up which annuity fits which person. So watch this. This is like driving a car where the engine power depends on the weather. On a sunny day, you're flying. In a storm, you're barely moving. Because the money is in separate accounts, basically mutual funds, the owner takes all the risk. The mistake candidates make is saying the insurance company guarantees the account value. They don't. Only the death benefit is typically guaranteed. If the market crashes, the owner's cash value crashes with it. That's why you need a securities license to sell these. Right, quick note. Think of this like a safety net that also has a ceiling. You can't fall through the floor, but you can't jump through the roof either. These track an index like the S&P 500. If the market goes up 20%, you might only get 6% because of a cap. But if the market drops 20%, you get 0%. You don't lose money. What's the trap? Students think the owner gets the dividends from the stocks in the index. They don't. You get the price movement, not the dividends. That's a classic exam trick. Now, here's the thing. Selling a long-term annuity to an 85-year-old who needs cash for medical bills is like selling a semi-truck to someone who just needs a bicycle. It's the wrong tool for the job. The exam heavily tests suitability. If a client needs liquidities or has a short time horizon, an annuity is almost never the right answer. Candidates often get distracted by the high interest rates in the question and forget that the client can't actually touch the money without penalties. Always look at the client's age and need for cash first. We covered the big ones, confusing the phases, picking the wrong payout, forgetting LIFO taxes, and ignoring suitability. If you can spot these traps, you're already thinking like an examiner. Annuities aren't about memorizing numbers. They're about understanding the trade-offs between safety, income, and access. Take a second and think about how much more you actually understand now compared to 10 minutes ago. That's progress. To turn it into exam day confidence, go run a free practice test on insuretutor.com. Like and subscribe if today helped. You got this. Just keep the momentum going.